Good morning. It is Monday. It is recap and preview day. It is the Bubba Show. Hope everybody had a great weekend, and I hope you can tell by my attire we're still in the Arctic deep freeze here in Chicago. But it is time to go, and we have to deal with the weather we have, not the weather we want. The last week, quite an interesting week. It was a short week, and Tuesday we opened up like a house of fire, and markets looked like they were going to the moon, and all of a sudden they just happened to reach a double top, and as I like to say, down go went Frazier, and markets kind of churned the next couple of days, and on Friday we had the bloodbath, and pretty interesting. In fact, we're going to do a segment this week on Friday's trading action, but very interesting to take a look at the overall action. You know, we've been talking about a potential top in this market for a couple of weeks, and and I've stood my ground, and not tried to not tried to force the market, nor did I trade against it. I was waiting for a level, but I did feel that a top was certainly in place in the market, and that certainly we were, the risk is to the downside, and I still look at that as the market looks to have the risk to the downside. And that's the step that I'm going to take here, is I'm going to continue to look for opportunities to sell the market, because what you're seeing now and what you saw last week is the late money trying to come in and continue to buy the dip, and the buy the dip mentality. But I don't think that that is the correct philosophy or the correct strategy anymore. As you look at the market, you can now see that the Fed is starting to waver a little bit. Everybody says, well, the Fed, and that was always the reason for the rally. Well, now you see the Fed starting to waver. There's a little bit of dissent throughout the ranks of the Fed governors and what they want to do with the rates and what they want to do going forward. So as you look at the big picture, last week was no real surprise, nor was Friday. We've had plenty of big down days. I mean, in the big scheme of trading, we were down 1.25%. It's not a real big deal. Think about it. It's like a $20 stock, being down 30 cents. I mean, that's really what it came down to. Okay, it was a bloodbath. It was ugly, but that's what it was, and it certainly was expected. You had, once the selling accelerates, and you can see that we've had bigger selling pressure, bigger volume on down days. So why would we be surprised that that the market finally got there? So now you want to look ahead into this week. What's going to happen? Well, today it'd be kind of interesting to see, first day of the month. So typically the first couple days of the month you typically get a rally. Now maybe we will, maybe we won't. But what I want you to look for is I want you to look at 1650 as a level on the S&P. I would be looking to sell at that level. We closed down around the 1625, 1630 level. I'm looking for 1600 for the next test to the downside. Now we will get rallies. I mean, this is not going to be a straight word down movement and the world is coming to an end. This is a market that's tradable, and that's what we want. Is we want markets that are tradable. So as we look into the week, we've got a lot of news this week that can be market moving. But the biggest two numbers are Wednesday with the ADP private sector jobs number, and Friday with the unemployment, which we'll talk more about the news. But those are the things that can drive the market the hardest. But what you want to look for here is you want to focus on the new direction. It looks to me that the bears are firmly in control right now. Now the long-term trend is still higher, but we are starting to show in the shorter term that we look to see some heavy selling pressure. Buyers are starting to step away, and there's another interesting note to take. Interest rates are rising. So if interest rates are rising, that now competes for the equity dollar. And what that means to us as a trader is, if we are correct with our assumption that the top of the market is in, and if we are correct with our other assumptions, then fixed money, people that are on fixed incomes who were forced into the market to chase that yield, can now take their money and put it into the bond market, which is a little bit safer for a fixed income. So as interest rates rise, they compete for those equity dollars. So although you always hear the story, there's money on the sidelines, there's always money on the sidelines. But right now, don't be surprised to see money coming out as interest rates rise. The interest rates now are at a year's high of where they've been. So the bond futures, which we've been telling you to sell, are at year lows. And it's very easy to understand and take a look. So let's look for some continued action, but don't be surprised if you see a rally, it shouldn't shock you that a rally would appear here. What we want to make sure is that we're prepared to react to the levels when they hit. And that's our focus here, is looking for opportunity and we're looking for the downside of the market here. As I'm saying, the risk is to the downside. If you get caught short, yeah, you can get stopped out, but the risk is still to the downside, and the bigger money will be made to the downside of the market right now. Remember, Average Joe Options calls tonight. If you're not on it and would like to be on it, email me at todd@averagejoeoptions.com. I'll hook you up. For Monday, the Bubba Show. Have a great day. We'll talk to you on Tuesday.